Hey guys, what's going on? Welcome back to the channel. It has been a few days since I've made a video. I think it's almost been a month since I made the last video. And on the last video, or the last couple of videos, I said I was gonna take a vacation and come back to the channel and talk about what's going on like I normally do. But unfortunately, on my way back from my vacation from New York, about an hour out, I drove back, super long drive, I got sick. I started getting really the chills, the whole works. As soon as I walked in the door, I told my wife, I said, I have COVID. I was certain of it. I felt absolutely terrible. Went straight to bed, woke up the next day. My wife gave me one of those at-home tests, and of course I was positive. I felt absolutely terrible. My wife also tested positive. She didn't feel quite as bad as I did. She had low energy, a cough. I was just in bed for days. It was terrible. I ended up getting the monoclonal antibody treatment, which helped tremendously. I'm not advocating it to anybody. I'm just letting you know what I did. And it helped me get back on my feet. My energy is still really low. Now, I'm not sharing all this stuff because I'm not really a sharey kind of a person, but what I do want to point out, and in this video, I want to talk about performance and the way that you go about your financial planning. And what does this have to do with my vacation and me getting sick? It's the types of strategies that you put into play and your ability to enjoy life or unfortunately get sick and not have to worry about those things because you did it in such a way that you can basically kind of set it and forget it. Now, I'm gonna talk about performance on this channel today or in this video, which is not something I really talk about that much. And mainly it's because of the regulators. I'm kind of apprehensive about talking about it, but I think I've put it together in such a way that it won't be an issue. I'm gonna give you all the disclosures under the sun, that this is historical numbers, not a guarantee of future returns. But I wanna show you the way that I've been investing for years and years now, and it works. And it makes a lot of sense, and hopefully it's something that you can relate to, because I don't think anybody in the industry or out there really talks enough about this stuff. That the way that you're going about it, the whole system is almost designed to get you to take action constantly and make trades constantly. And it's just not the way to do it. I have not done that almost ever. And I'm gonna show you the results of it. And I'm gonna show you why it's so important to invest like this and how you can still invest, still make a ton of money, but not have to place that many trades. And there's just so many more benefits to it that I want to point out. So let's first start about how we're looking at the market, because right now we're dealing with a ton of things in the market, and really this is no different than before, but we have issues going on with Russia. We have issues going on with China. So we have global issues. We have inflation creeping in. We have prices going all over the place. Housing markets going nuts. Rents are going up through the roof. I'm in Tampa, Florida, and I just read an article the other day that Tampa had the highest rent increase year over year, something like 24%. So there is a lot going on, and not to mention the pandemic. So there's a lot that you have to contend with when you're looking at your investments. And a lot of the pundits on TV and other YouTube channels are telling you that you have to react to it. And I don't agree with that at all. I don't think you have to react the way that they're telling you to react. And they're telling you that you need to place trades, that you should have this much cash, or you should buy this sector or these positions, that your portfolio is gonna need to be reworked because some factor that they think is gonna change everything has come to fruition, but it's, in my opinion, it's really not a lie, just kind of misleading. So let's go ahead and look at some stuff here. And I want to start with this. I'm going to bring this up on the screen here so we can look at this together. And here we go. We got the screen and me. So this is a chart that I've talked about, the matrix chart that I've shown in the past, and I've put on the blog. TheIncrediblePenny.com is the blog. It's not our SickleHunter.com website. It's the blog that I put some information that I talk about on this channel, just so you have the links and I believe this is on there. If it's not, just let me know and I'll put it on there. But these are the rates of return of the S&P 500, And let me zoom in. If this is the first time you've seen this chart, it's actually a really cool chart, in my opinion. Everything on the channel is my opinion. So in 2020, the S&P 500 did 18.4%, 2019, 31.5, so on and so forth. So what we do is we can take 1 year and look at another year and kind of find what the annual compound rate of return is. So for example, if we look to 2020 to 2013, we know that an annualized rate of return of 15.2%. If we scroll all the way to the left, we can see over time, kind of like a normalized return. Can you expect over time? From 1926 to 2020, the S&P 500 did 10.3%. Now, we take that number and we think about it for a second, and we think, well, 10.3%, so I know that I'm not going to get 10.3% every year, but let's face it, you actually think you are. You actually think every year it's benchmarked against 10.3%. And if you're invested in an index fund, you're expecting 10.3% each and every single year, even though you're telling yourself you're not. But everyone thinks like that. But that's not the reality. Almost none of these years you're going to get exactly 10.3%. You're going to get something different, right? That's what usually happens. But here's the thing that we don't pay attention to. And again, I'm going to go back to 2020 of 18.4%. And let's go ahead and pull up this cool website. It's koifin.com. So the S&P 500 chart, this is not a total return chart. So now we have it up on the screen. And what we're looking at, this dip right here. Look at that. That dip. You remember it? You probably already forgot about it. I just showed you what the 2020 S&P 500 did for the entire year. But we don't look at the dips in between. We look at the point to point. So we see 10.3%, and that's what we assume that we're going to get. But as you probably are aware, what does the S&P 500 do over time? It's all over the place. I mean, probably some of you watching this channel might not even remember, but from 2008, some of you, of course, will, down 37%. And look at that. The year before was 5.5%, 2007, drastically down, and then drastically up at 26.5%. So a ton of volatility. But if we dug into those years, it would look even more volatile. And that's basically how we experience the market. And we're constantly pegging it against it. But something else that's strange that a lot of times happens is that, let's go back to this for a second, for 2018, down 4.4%. Now, for a second, think of 2017, and let's say you had all your money in the S&P 500, you opened up your statement, you got 21.8%, you're thinking, hey, this is great. For whatever reason, you decided to make a change. You changed it from one S&P 500 index fund to the other. And then a year goes by and you look at your returns and you're like, I'm down 4.4%. Most people, in my experience, would look at that and say, this new fund was terrible. I should have stuck with my old fund. But that's not true. That's just not the way to look at it. You can't look at that and say, I'm down 4.4%, therefore I should go back to my next fund. And of course, if you did that in 2019, you would have thought, okay, I made a bad decision, but I fixed it and we got 31.5%. No, you didn't do that either. What you need to go back and look at is what type of trading strategy are you using? If you're using a diversified strategy, you just want to make sure that your whatever fund it is, if it's an S&P 500 fund, you want to make sure that it's tracking the S&P 500 if that's your objective. But if you're looking at individual stocks, you want to go back to make sure the fundamentals are strong. That is what you want to take a look at, not what's the rate of return on an annual basis, and let's compare 1 year to the next. Now, you can do that if you want. You can do whatever you want, but it's not going to help you improve your portfolio. The other benefit to doing the trading that I'm talking about is getting in and out of the market. So a lot of people will look at things and they'll turn on the TV and they'll hear GME and AMC. You remember that? Well, guess what? People were getting in and getting out. But what you were probably looking at is where it was before the, I think it was the Reddit articles that made it take off, before and after. You're not looking at the in-between. And then you're also not looking at the actual trading strategy of all those investors that piled in, piled out, piled in, piled out, and constantly created this artificial volatility in these stocks. And all we're looking at is the beginning and the end result. We're not looking at the middle, but the actual trading strategies of a lot of those investors was absolutely horrid, because the truth is very few people got in the beginning, very few people got it at the high, and they're kind of stuck somewhere in the middle where some people made money, some people lost money, but your perception is, I should have owned that position. But the problem with that kind of a trading strategy is that you have to pay attention to the news all the time, because any of those technical changes are going to affect the stock price and they're going to affect your investment. And because you haven't looked at the fundamentals and you don't believe the fundamentals are very strong, that you have to get out of the stock, because there's really no basis for it to be that high at that point, except for some, what I would think is more or less more aligned with wizardry than actual acumen in investing. So I'm saying all this, and you might be agreeing with some of it and disagreeing with some of it, or maybe just looking at me and saying, hey, I don't know what he's talking about today. But I want to show you this, the performance. And this is the result of a sampling of several accounts that we have. I've redacted a bunch of this, so I just want to point out these numbers. Now, I'm not saying that we can do this each and every single year, because we absolutely cannot. That's my disclosure to you. So here we go with the starting date. Now, I have a sampling of 5 separate accounts that I've aggregated and shown the rates of return through our system. And this is going back from February 28th, 2011 to January 20th of 2022. Now, we have a starting market value of $297,527, as you can see right there. Might be a little bit on the blurry side. Unfortunately, there's not a whole lot I can do on that. Let me go ahead and zoom in a little bit more so you can see it. But we have a starting of 297,000 total inflows, and they could be sporadic, the way that we're doing these calculations, of over 6.6 million, and the outflows over that time frame were 4.2 million. That could be for a ton of different reasons, just normal distributions, clients requesting money, whatever. It could have actually gone into other accounts. That's what the outflows are. Income, things like dividends over that time frame. Market fluctuations, 19.6 million, with a total ending value of 22.4 million, and a TWR, which is the time-weighted return, which is, in my opinion, really the only way to actually do calculations for a rate of return. I'll explain why. With an annualized 18.96%. To kind of give you apples to apples, and honestly, this reporting tool is not very good. I should have been able to put the S&P 500 right below it over that exact time frame to show you what it is, but for whatever reason, this reporting tool wouldn't allow me to do it. So let's go ahead and go back to that Koifin charting tool, and we can see it's 243% over that time frame, not reinvesting the dividends, which I'll flip over to this reinvestment calculator just to show you the rate of return of the S&P 500 over that time frame. That same 253 works out to 12.255%. If we reinvested the dividends, so a total return, it would be 14.4%. We killed the market. So that is a huge amount. That is a huge difference in those numbers, from 18.96%. So if we round that up to 19%, or round it down, I don't really care. 18%, doesn't matter. 18%, significantly better. That's an annualized basis to make a huge difference in the rate of return, to go from the 14 to the 18, or not the rate of return, but your ending result, significantly more. And I didn't calculate how much we would actually have because of the inflows and the outflows. That's why you do the time-rated return. So the time-rated return basically eliminates any of the inflows or outflows. It's just purely a rate of return, and it's a good indicator of the investment performance of a particular account. Think of it logically. If you put $50,000 into account, it grew to 100, you took 50 out, you still have $50,000. So if you open up the statement, you see 50,000 as the beginning, 50,000 as the end, you're not going to get an accurate rate of return. That is what the time-weighted return will consider. So it will consider all those inflows and outflows and the length of time that you've held them. So it eliminates all of that, which is kind of a cool way of doing the rate of return with the inflows and the outflows. Now, you'd actually get the exact same rate of return if there were no inflows and outflows, okay? But because these are real accounts and we have inflows and outflows and different timing, then the time weighted return is the way to go. But the point here is that I'm not just telling you, hey, this is the way to go. So many conversations I've had in the past where people have told me that they've gone into a particular position or they have a portfolio that's done really well and it's a very small time frame or it's only a very small dollar amount. Now, if you're just starting out, that's perfectly fine. There's nothing wrong with that. If you're just investing a couple $100s at a time, nothing wrong with that. But you can tell the difference of actually investing millions of dollars versus investing like 20 bucks and saying, hey, I bought GME at the low and I sold it at the high, so we made a couple $100. But let's face it, it's just a couple $100. It's not really the meat and potatoes behind investing and saying, yes, I actually believe in this type of investing strategy. Now, with these particular accounts, we've invested everything from index funds to individual securities inside of these accounts at one point or another throughout that time. But the amount of trades that were placed in these accounts is, I almost would guarantee that it's astronomically lower than almost anybody else that I know that does trading. And the reason is because here is how I believe the best way to invest is spending all of your time doing the research, all of your time figuring out which positions you want to buy and the why behind it, and continuously doing that research even after you're placing that trade, and spend very little time actually trading. And the reason that is, if you think of like an athlete, I always like to make this analogy. How much time does an athlete or anybody that's good at what they do spend training versus actually playing or participating or executing, whatever, right? It's so much time spent in doing it. And all you're seeing is the tip of the iceberg as the result. So you really got to take a step back, and it's not about sitting there and saying, okay, the market's open, let's go ahead and get out. You know, this thing is green and this thing is red and your screen looks like a Christmas tree after 15 minutes of setting it up because you're looking at so many different positions and your head's going to spin and it's going to explode. And if you're not feeling good, you're going to make a bad decision and that could ruin your portfolio. Look, all you need to do is go back to the fundamentals. If you think about how Warren Buffett invests, why would you do it any differently? So I looked at the way he was investing and that route of doing the research, reading the annual reports, going back to the basics. Here's why I say that the whole system is rigged. And I'm not trying to be some conspiracy theorist behind this, but if you look at what's available to the average person, reports are available. Now you have to dig sometimes to find them, but the reports on things like Yahoo Finance, Google Finance used to be a thing, but it's not, I don't even think it's really a thing anymore. But all these platforms only give you like a couple of years worth of financials. You can't really see the trends. You can't really understand how the company is working if you're only dealing with a single annual report. It makes it very difficult. You might understand the operations, but you're not going to understand the financials because we don't know what is kind of hidden in those financials unless we're looking at multiple years. And until you upgrade some of these systems to pay into it, do you get access to more of that data? But it's not sexy. People, it doesn't sell as well. What sells are fancy looking charts, trends, news to get into stock or get out of a stock, or why this is the way to go versus that. And you have to make that decision right now. That's ridiculous. That is not the way to invest. Now, you should be super patient and you should take a step back and not have to deal with it through all of this turmoil, all of this noise, because that's what it is. If you think the game has changed, you're wrong. I hope this is basically showing you that this is the way to do it. This is the way. So, when you're looking at your portfolio, if somebody's telling you to make a lot of trades, make a lot of changes, how does your performance reflect over that time frame? Look at larger dollar amounts. Look at your actual nest egg and say, how well have you done? And if you've done well over time, stick with the course. Stay the course. Figure out what's your basis, what's your investment policy statement, how are you going to invest, and how are you going to execute on that? And it just reminds me of everything that's going on, getting sick, not being able to stay on top of every little thing. Of course, I was read things all the time. on the individual positions that we own just to learn more, but not necessarily to make a knee-jerk reaction on one piece of news. You have to look a little bit further. And most of the articles are written to get clicks. I mean, just look at some of my other videos. There's the reason why the thumbnails and the titles are written and presented the way that they are, because it is a game to get more clicks, to get more views, and it's not about necessarily the content. And I think a lot of articles that are written out there on individual stocks are written to get clicks, to get you to look to what might shock and awe you. So you need to look past that. You can read all of the articles. I read all of them, but I still take a step back. And before I make a decision, I go to the annual reports, I go to the fundamentals, and that's where we're making our decisions. And we're not making rash decisions. We're trying to make calculated decisions over longer periods of time and be as patient as we can. Now, when the facts change, you can change your mind and you can change the course, but it's a fine line. It's much easier said than done. And there's going to be times that you're going to be challenged. You're just going to be more times than you're going to be challenged than not. But that is what it's all about. It's about taking the step back, making sure that you have an investment strategy that you can actually deploy and not have to be glued to the screen. Doesn't mean you can't continue to do the work, but you shouldn't have to be at the screen ready to place that trade at a moment's notice because some stupid technical chart changed. And if you're not familiar with any of this stuff, there's technical and fundamentals. Technicals, if you're thinking about it, well, I want to be a technical analyst. Technicals are like trends, where the fundamentals are actually looking at, does this company have cash in the bank? Do they have a low amount of debt? Are they actually making money? Those kinds of things. Those are the fundamentals. Those are not technicals. Those are the fundamentals. So if you're not familiar with that, look a little bit further into that. That's the way to go. That's what you should be looking at. So it's good to be back. Hopefully I'll make more videos this week. We'll get them out and I'll be back like I've always been, churning out videos, answering questions. And let me know what you think of this video. And it's good to be back in 2022. If you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.